Hello and welcome to the latest episode of Chart TV. My name's Malcolm Gordon, and today we're going to take another look at determining seasonality in markets. When we're looking for seasonality, we're looking for cycles that repeat over and over and over again. We're looking to find patterns in a market so that we can profit from them, and we can decide what is the best time to be in and out of the market. So essentially we want to time the market. Alright, so what I've been doing is I've been looking at charts such as this one, and this is the Australian market, the benchmark for the Australian index. Though what I'm about to do can be applied to any market, the S&P 500, commodities, futures, oil, gold, whatever market it is, you can apply this sort of analysis to it. Okay, so what we have here is this market on a weekly chart, and what I've gone and done is I've gone and determined the highs and lows for each year. So for example, for the year 2005 with this market, the high for the year was in December, so it made its high in the last month of the year, and the low for the year was in May. So what I've gone and done is gone and created a basic Microsoft Excel worksheet like so, and I've gone and jotted in that the low for the year for 2005 was May, and the high for the year for 2005 was December. Okay, I've then gone and done that from 2005 through to 1987, as we have here, and I believe that the more data you have, the more accurate, the more reliable your results are going to be, and the more robust any system you base on these results is going to be. I should also add that what I'm doing here can be applied across any time frame, so you can do this. I'm doing it here, highs and lows on a yearly basis. You can apply it on a weekly basis, a monthly basis, a daily basis, like to the half-hour period, to the 15-minute period. You can break it down or push it out as far back as you like. It's up to you. And that's the beauty of like an analysis like this. Like it's something that you can apply across all time frames is what I would term robust. And robustness usually leads to consistency. I want to build something that will last me years, that will work for years, and what I'm doing here hopefully will help to achieve that. So anyway, what I've done is I've gone and jotted down these highs and lows from 1987 to 2005 for this market, and I've gone and run some stats in them. So I've done a count. For those of you familiar with Excel, I've run a count if formula, so I've done a count if for all the Januaries, all the Februaries, etc., and I've come up with the stats. And what I've come up with is interesting. It's shown that, for instance, with this market, January lows were made in January 16% of the time, and highs 11% of the time. For the month of May, lows were made 11% of the time, yet no highs were made in May for this time period. Interestingly, December appears to be, and October appear to be immensely bullish months. We can see here that October highs are made 21% of the time, and highs are also made in December 26% of the time. So it looks like the last quarter of the year tends to be quite good for the bulls. But also on the flip side, the October and November lows were made 16% of the time, which is quite a rating. Incidentally, December had lows made only 5% of the time, so on the whole, December appears to be quite a bullish month for this market. Okay, what I've gone and done is tabled these results up into this little table here, and this table's all well and good, but I prefer to see things graphically. I'm more of a visual person, and I pick things up better if I see them graphically. So what I've done is I've gone and created a chart for this. So I've just highlighted this data set and gone insert chart, and I like the 3D. You can muck around with all sorts of chart types in Excel, but I've just gone for the column, 3D column, and next, and that looks good to me, and so does that looks fine. I might put a little title in later. That looks good to me, and let's finish. And there we have it, folks. There's my chart of the highs and lows for this market from 1987 to 2005. We can see here that on the whole, December is the most bullish month. October also tends to be quite bullish. August, neither highs nor lows were made in August. And the most bearish month, I guess, where most lows are made, tend to be January and February. So, and September as well. No highs made in September, yet lows made in September. So what I can do is I can go and, based on this data, go and create, this gives me valuable insights to my market. Please feel free now to go ahead and try this on your market and see sort of what insights it will give you. I hope this has been some help to you. Righty ho, my name is Malcolm Gordon and this has been the latest episode of Chart TV. Thanks for watching.